Let's take a look at a quick example, which is also a very standard interview question. Starting with the income statement, we have a $10,000 depreciation expense, which this example is attributing to COGS. Note that this is just an assumption. It could also be run through OPEX, or it could be split between OPEX and COGS. Looking to gross profit, since depreciation is allocated to COGS, gross profit will fall by $10,000. Note, if depreciation is allocated to SG&A or OPEX, neither COGS nor gross profit would be impacted. Onto the operating income. Regardless of depreciation allocation, operating income / EBIT will fall by $10,000. There is no change to interest expense, so profit before tax, or EBT, will also fall by the same $10,000. We now need to consider the tax bill, right? Depreciation provides a tax shield. So, at a 30% tax rate, a $10,000 reduction in EBT will result in a $3,000 tax savings. $10,000 times 30%, $3,000. Ending at net income, our net income decreases by $7,000 given the $3,000 reduction in tax expense. Moving over to the cash flow statement. Start with net income, which is down by $7,000, right? We take our net income from our income statement, move it to the first line from our cash flow statement. We add back depreciation since it is a non-cash expense, so cash from operations actually increases by $3,000. No impact in cash from investing, no impact in cash from financing. So ending cash is up $3,000. Now we take the cash over to the balance sheet. So we have a $3,000 increase in cash on the balance sheet. PP&E decreases by the amount of depreciation, which is $10,000. So we have a reduction in total assets by $7,000. If we go back to our standard equation, assets equals liability plus shareholders' equity, we know that the asset side of our equation goes down by $7,000. Therefore, our liabilities and or equity needs to go down by $7,000 to balance the equation. So where does that come from? Well, we know that net income rolls into retained earnings. And we know that retained earnings is a part of our shareholders' equity. So therefore, our net income is down $7,000. Our retained earnings or our total equity is down $7,000. Our balance sheet balances.